Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be discussing one question of cost sheet where some typical items are given like haulage charges. Let us see the question. Bharat Electronics Limited produces a standard product and provides you the following information for the year ended 31st March 2016. Raw material, it is information of direct materials. Opening stock, it will be added to direct materials. Purchases, it will be added to direct materials. Closing stock of raw material, it will be deducted from direct materials. Custom duty, custom duty is paid when we import raw material. So it is an expense relating to raw material, therefore it will be included as a part of direct material cost. Direct wages, direct labor, chargeable expenses, direct expenses. Haulage charges, this is an item which is typical. It means a charges for carrying goods up to port. For example, factory is located at X place. From factory, for carrying the material from X place to the port or from port to X place, usually railway transport is used. The charges which are taken are called as haulage charges. These haulage charges should be considered as factory overheads. Loose tools written off, factory overheads. Works manager salary, factory overheads. Cost of rectification of defective work, factory overheads. Office overheads, 10% of works overheads. This is the information of administration overheads. They are based on 10% of factory overheads, works overheads. Selling expenses, rupees 4 per unit sold. Finished goods, opening stock 1000 units. Its value is given 1,59,920. This will be added to cost of production. Unit produced during the year 10,000 units. Closing stock of units 2,000 units. This will be deducted from cost of production. Profit desired on cost 25%. On cost means total cost. Here we are required to find out the number of units sold. We are required to use formula units sold is equal to opening stock of units plus unit produced minus closing stock of units. Opening we have 1000 units. Opening we have 1000 units. Unit produced they have given 10,000 units. Closing stock they have given 2000 units. So 1000 plus 10,000, 11,000 minus 2000. So units sold are 9,000 units. We have discussed all the items of cost sheet. Let us proceed to prepare it. Opening stock of raw material is given rupees 1 lakh. Purchase of raw material is given 8,45,000. Custom duty is given 5,000. It's a expense on direct material. Closing stock of raw material rupees 40,000. So direct material consumed rupees 9 lakh 10,000. Next we have direct labor rupees 2 lakhs. Chargeable expenses, that is direct expenses rupees 1 lakh. So we got material, labor and expenses. We can add them to arrive at prime cost. Total number of units produced 10,000. So we can calculate per unit cost. To the amount of prime cost, we are required to add factory overheads. In factory overheads, we have haulage charges rupees 10,000. Loose tools written off rupees 20,000. Works manager salary rupees 1,65,000. Cost of rectification rupees 5,000. Now we can add all factory overheads. We can add factory overheads to prime cost. We got works cost 14 lakh 10,000 per unit rupees 141. To this we are going to add office and administration overheads. As per the information in the question, office overhead should be taken at 10% of works overheads, that is of factory overheads. Our total factory overheads are 2 lakhs. 10% of 2 lakhs, that will be rupees 20,000. So we got cost of production 14 lakh 30,000 and per unit it is 143. To this we are required to add opening stock of finished goods. It is given in the question opening stock 1000 units, value is 1,59,920. So if we add opening stock, it becomes 10,000 units produced plus 11,000 opening stock, it will be 11,000 units and the total cost is 15,89,920. From this we are required to deduct closing stock. Closing stock of finished goods. In question they have given closing stock 2,000 units. Now here they have given units 2,000. Value we are required to find out. Here cost of production per unit is rupees 143. Closing stock is unsold units that will be valued at current cost of production per unit, that is rupees 143. 2000 units multiplied by 143. Closing stock will be 2,86,000. After deducting it, we get cost of goods sold 13,03,920, and per unit it will be 144.88. To this we are required to add selling overheads. In question they have said selling expenses rupees 4 per unit sold. After adding selling overheads, we get total cost 13,39,920, and per unit it will be 148 rupees 88 paise. To this we are required to add profit. It is given in the question that profit desired on cost 25%. So we have to add profit 25% on cost. So profit will be 3,34,980. By adding this, we arrive at sales 16,74,900. Here selling price will be 186 rupees 10 paise, profit 37 rupees 22 paise. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.